Hello and welcome to KYC. Today our focus is on Rainbow Children's Medicare Limited. It's a hospital chain which deals with child care, childbirth and the like. In simplest of terms, established in 1999 in South India. Let's pull up some data with regard to the company. It was started as a small clinic and thereafter has forayed and has grown extremely sharply. In terms of the locations, etc., we'll come to, but let's first focus in on what it actually does. It operates a multi-speciality pediatric obstetrics and gynecology hospital chain. The hospital chain focuses on all of the following care in terms of, largely in terms of childbirth. And it currently has a presence in 5 states, across 6 cities, has 19 hospitals and 1900 plus, to be absolutely specific, 1935 beds. And that's how it's stacking up at the end of Q2 FY25. In terms of the business itself, you're looking at a size of around 16,500 crore in terms of market cap. You're also seeing that it got listed in 2022. If you can have the 5-year chart of the company, you'll see it's given a very strong return. Since May of 2022, the stock has gone from 450 odd to 1620. So from the date of listing, it's given very strong gains to shareholders in the hospital space and a healthy return in terms of return ratios as well that the company offers. But let's dive deeper into this one. Let's try and see and zoom in, because on every one of KYC shows, we try and rate each company on the basis of 8 performance parameters. The first one being the income statement, then it's the balance sheet, how healthy is the balance sheet, return ratios is the third, how cash flows have stacked up historically last 3 years, as well as what one can expect going forward is the fourth parameter. The fifth one is on shareholding, how much is the promoter holding, and sixth focuses on street cred, how the performance of the stock has been. This one of course has been very strong. We'll try and break those numbers down as well. Street coverage, how many analysts track it, how do analysts view the company, that's the 7th parameter, street coverage, and 8th one is the valuation picture. This company versus others, how do valuations stack up in relative terms? Is it a good investment to make at this point? So we'll try and break all of that down. Joining me for that is Puneet Javeri. Puneet, hopefully we'll break this down in a nice and healthy manner for viewers. Let's first start off with the income statement. And the income statement, smaller company, and therefore growth has been very good, reflecting on that income statement over the last 3 years odd. The revenue CAGR has been around 24%, strong revenue growth. It's doubled in the last maybe 3 years odd in terms of revenue. From 650 crore, the revenue has gone to 1300 crore in FY24, and it grows at a fairly healthy clip even in FY25. In fact, FY25's Q2 numbers were extremely strong. One of the quarters they clocked around a 450 crore rupee top line. So therefore, the growth, the revenue growth in that sense looks quite good. You've seen a 24% CAGR, 3-year CAGR on the top line. EBITDA also very similar kind of growth, 30% growth on EBITDA. So some amount of operational efficiency also kicking through. And your EBITDA margins as per the revised Ind AS is at 33%. Earlier was operating at around 27-28% as per earlier Ind AS, but currently at 33%. PAT CAGR as a result, on a low base of just about 39 crore in FY21, PAT has zoomed to 218 crore, and that's why you've seen that 76% CAGR in terms of profit after tax. Can that sustain, grow? What's the direction in which it will go is something we'll have to zoom in on better. But that is of course forward guidance, what one can expect going forward. The second one is with regard to the balance sheet, and I'm going to try to break this down into 3 metrics. One is the shareholders' equity. Healthy at this point, 1367 crore of shareholders' equity. A large component of that is premium. Some amount of that premium is attributable to the IPO itself, which happened 2.5 years ago. But a large component of the premium is also profitability, which continues to accrue. Mind you, 218 crore of profit in FY24, likely already sitting in that number of 1367 crore as of September 2024. So that's one metric. The other one is the gross debt. A large part of the gross debt, it's a debt-free company largely, but a large part of the gross debt is lease liabilities. Generally, land is leased, building is leased, and therefore some bit of this debt reflecting here is lease liabilities, or rather large part of it, 700 crore plus is lease liabilities. And therefore the gross debt is largely zero. We'll have to, ask management as to what the capital allocation strategy is going forward, what the growth strategy is, and how they intend to fund growth. That will be an interesting conversation, and we'll have the management with us shortly. The third piece on the balance sheet is the cash and bank balances. They've got investments which are quite sizable in that sense, but the cash bank balance is just about 26 crore odd, which is also healthy for a company of this size. Decently healthy cash and bank balance sitting in. One more thing I want to just highlight as part of top line and balance sheet is that there's a 50-50 split between the revenue which comes in from insurers and revenue which comes directly from customers, which is uninsured treatment that the hospital chain is currently servicing. And therefore, it's kind of a 50-50 split where 50% is coming straight from insurers. So some amount of visibility even in terms of cash flow there. Now, coming straight to cash flow, because that's the important metric. Cash flow from operations has grown, again, very healthy clip, largely in line with that EBITDA number, 30% growth. But you're looking at net cash flow, which is negative. Fair point there, because what you will see in fast-growing businesses is all the cash flow that comes in gets invested fairly quickly. And therefore, the important number to track here is the cash flow from operations, which is growing healthily in line with EBITDA. And the second metric is going to be return ratios, because once that cash is invested, what's the kind of return that the company is generating on that? And Puneet's going to break that down for us.
Well, definitely, because the return ratios, while, as you already said, it's maintained at a very strong clip. The ROE is around 19%, so it's been very steady over the last few years as well. I think post that FY21 blip, and that was getting accrued to the pandemic, it was a one-time effect. When you look at the return on capital employed ratio as well, that's also very strong at about 18.2%. That's another key positive for this company as well. And for the industry as a whole, as a hospital chain, it is expected to maintain a decent clip. Because of the other peers also investing capital very quickly, as you rightly said, Harsh. But, it's maintained at a good 18.2%. Let me move on quickly to the shareholding as well, because that's another aspect to look at. It's been steady at around 49.8% for the promoters, while, we have seen strong participation from FIIs, specifically around 25% of the shareholding is with the FIIs. There has been decent interest in terms of DIs as well as from the public as well, public investors as well, in terms of this company. Finally, when you look at the street cred as well, as you rightly said, Harsh, from May 22, the stocks been almost up about 2.5 times or 254% since listing in May 2022. It's given, when you look at the returns CAGR on a yearly basis, about 54%. So it's done very well for us investors who participated in the IPO and henceforth as well. So definitely a key aspect. Of course, you rightly mentioned that the company is a very high-growing company. So the investments have been higher, and that's the reason for the negligible dividend yield of about 0.19%. But I think the reason we've given it, of course, a thumbs up is, of course, it's opening newer hospitals as well and requires that kind of capital. So definitely on that, the dividend yield will be accepted by the investors because it's a high-growth company. But Harsh, what about the street cred as well? What is the analyst currently thinking on the street according to for this company specifically?
Yeah, absolutely, Puneet. So interesting point made there that dividends generally, I'll just cap that point off. Dividends generally are lower for fast-growing companies. Also, the important metric to track when dividends are low is the return ratios. And return ratios here are higher teens.
Yeah.
And therefore, they're deploying cash at a far faster rate than your average company, or rather the average returns offered by companies in the listed space. And therefore, that dividend number is not so bad. Let's look at, though, the street coverage. There are 11 analysts which track this one. 9 of them have a buy rating on it, but the upside is what the key is, just about 2%. And therefore, while 80+% analysts have a buy call, the upside is absolutely muted. Therefore, the next 12 months, analysts don't expect much, even though they're quite constructive on the business per se in the longer term. But Puneet, let's talk about valuations here, because likely that's the reason why analysts are not so bullish on this one.
And definitely, because, over the last 6 to 7 years, we've seen a number of, very nice hospitals get and list in the market as well. So when you compare not just on valuation, but also on the occupancy, on the, ARPOB, of course, is average revenue per operating bed, as well as the kind of capacity and bed capacity that they hold in the current hospital is another key metric to track. When you look at, the ARPOB for a company like Rainbow is the highest among the 5 that we've taken in this particular comparison. And that's also because of the niche that they operate in the pediatric space. That's, of course, giving them a premium compared to others in terms of the average revenue per operating bed. And essentially, when you look at the bed capacity as well, while it is currently around 1900 and it's lowest among the 5 that we've compared it with, it's interesting that the company is looking to increase the capacity by almost 50% over the next 3 to 4 years and going to almost 2900 installed beds at that particular time. Currently, the occupancy would be slightly something that, is a slight worry because of, it's fallen by around 7.5% to come in at 47%. So it was around the 55% range mark in FY23. And as of FY24 end, they've come in at roughly around 47%. So that occupancy is one of the key things. But of course, it's bear in mind that, this is a niche business of constructed around the pediatric care as well as the gynecology that Harsh spoke about. So that's one of the key things as well. When you finally compare it to the valuation, there we'll see a stark difference and a premium to someone like a Rainbow based on the other peers as well. So you see KIMS is another hospital that's gotten that kind of premium. They're also operating other hospitals and entering key states like Maharashtra while increasing the presence in the south. Yatharth is another one which is present in the western. But when you look at the other peers as well, comparing it to an Aster DM or a Shelby, it is kind of asking for that premium because of the higher ARPOB or the average revenue per operating bed, while also having a clear path to growth expansion over the next 3 years. So while the valuation has been, at a premium compared to the other peers, it seems that the street is quite happy with the company's niche focus as well as higher margins as well.
But what stands out for me, Puneet, as part of that is the ARPOB. I mean, the ARPOB is at 56,000 rupees, yeah. when others have a range of around 30 to 43,000. Yeah. So it's nearly 25% higher than everyone else. Yeah. Whether that can sustain or not is one question, but that is possibly one of the reasons why you're seeing the kind of valuation picture that you're seeing on Rainbow versus others. Not looking as expensive when you're looking at that ARPOB number, which is generally the right metric to look at. Also, occupancy is slightly lower, which is understandable because the space is niche. But, let's sum all of this up. Let's look at each of these metrics. Income statement, such strong growth, right? And therefore is a positive. Balance sheet is healthy at this point. Very little debt in that sense. Return ratios are very strong, high teens. You're looking at cash flow, which has grown largely in line with your EBITDA. Shareholding, 50% owned by promoters and therefore continues to be quite well held. FII's good interest being seen over quarters. If you look at the FII trend, very good interest in that sense. Street cred, well, it's been a very good wealth compounder, 26% in the last 12 months. And multi-bagger in the last 2.5 years. Street coverage is, flattish, and that's largely because of the fact that the upside here does not seem all that lucrative with just a 2% upside. And the valuation picture is negative largely because you're seeing that it's one of the most expensive hospital chains in that sense. So 6.5 on 8 is what Rainbow Children gets as part of what we have analyzed today. But let's quickly look at SWOT, Puneet. Strengths, weaknesses, opportunities, threats. I'll start with strengths. One, it's well recognized, right? It's a profitable company and it's in a very niche market. So what you're seeing is a company which is high margin, high growth in a niche market. Yeah. Always difficult to replicate as a business, and that's one of the key strengths that it has. Pediatrics, not too many listed companies, and not too many companies only altogether. And therefore, that is one of the key strengths of of Rainbow.
Yeah, but on the weakness side, of course, the valuation is one of them, but can't complain too much on valuations. It is getting rewarded for the kind of business they've built. And the falling occupancy is something that, we'll quiz management also about, because from FY22 to 24, there has been a drop to 47% as well. But, on the opportunity side, there is, quite a bit that we should also
Yeah,
address
it provides a range of services,
Yeah.
right, Puneet? You have a customer come in, you can provide him with far more services, which currently it does not provide because it focuses on childcare.
Yeah.
And therefore, you have a larger window of opportunity available for it to grow in terms of its service offering. Second is the scope for expansion. Currently focused on very limited geographies. We spoke about 5 states, but just about 6 cities. And therefore, the scope for expansion is very, very large in a high return kind of a business.
Yeah.
And therefore, you have free cash flow coming in, which you can always utilize for the purpose of growth and expansion.
Well, then the other part is, of course, the competitive intensity that's been increasing around the city, because certain, multi-specialty hospitals are getting into the space, and they're also entering the southern market as well, which is a big growth driver for the company. While the company's entry into the North Indian market has been slightly delayed, it's expected to start construction in March of 2025. So that's been one of the key things. But we will also be speaking about this to the management as well, Harsh, because the North Indian market is something that's, a very big growth driver going forward as well.
Well, yes, absolutely. So let's bring on board the management. Let's not delay this. Vikas Maheshwari, who's the CFO at Rainbow Hospital, talking to us live. Welcome, Mr. Maheshwari. It's good having you here. And it'll be great getting your perspective. So we've tried to break down your company, of course. The attempt here is to try and understand what the growth could be over the next 3 years. What's your sense, and where will the growth come from? Existing hospitals versus new hospitals? Just break it up for us.
Yeah, thank you. Thanks for inviting us, and wish you a happy new year to you.
Wishing
and
you
your
a very,
family.
very happy new year, sir.
Yes. Thank you very much. So as far as the growth is concerned, it will be on the 3 legs. One is the existing units, which we have the matured units. We keep adding the doctors, we keep adding the specialties. So the growth will come from there. 1/4 of our units are new units, which has to grow and mature. Which in our language, the mature and non-mature is less than 5 years. So we feel that another leg of the growth will come from there as they keep on growing for the capacity which we have added. And the third growth will come from the new units which we have planned. In the next 3.5 years time, we are thinking of adding 1,000 beds. We have already laid out the plan for roughly close to 800 beds in our geographies. Out of that, in the 4 years, 3.5 years, you will see these capacities keeps coming up. So the growth will come from there. Broadly, on all these 3 legs or the growth drivers which we have just laid out, we believe that we should be able to grow our company based on the capex plan which we have listed at around 15 to 18% growth, or mid-teen to high teens growth over a period of 3 to 4 years time.
Next funding plan, Mr. Maheshwari.
So we have a very healthy balance sheet. I was looking at your presentations. So we have a very large investments also, which is invested into the debt funds, etc. So that the cash is 25 crores, but close to roughly 575 crore rupees we have invested into the debt funds, and the company is generating very healthy cash flow of around 350 crore rupees every year, and it will keep on growing as the company grows. So as far as the capex is concerned, it will be funded internally through the existing cash balance of 600 crores rupees plus our internal accruals going forward. And with this, whatever the capex plans we laid out, we believe that we will always be remain a cash surplus company.
Mr. Maheshwari, good morning, and thank you so much for joining us today. It's Puneet this side. I just want to ask you expansion into the North Indian market. I think you are opening 2 hospitals in Gurgaon. Wanted to understand, because you've been focused on the south and steadily deepening your presence in cities like Hyderabad, but the North Indian market is of course very difficult to operate in because of the kind of competitive intensity there is there, while the company has also taken its time to go there. Just wanted to understand, because just looking at some stats, the North Indian market does account for 60% of India's annual childbirth. So wanted to understand what's been the company strategy, because these all will come only in FY28. So what would lead the growth in the next 3 years, as well as your thoughts on the North Indian market as well and your entry into the same?
So let me complete this in a different way. The growth from the south market, we are adding capacity in our existing market, which is Bangalore. Two hospitals are opening this calendar year. We are opening one hospital at Rajmundry, which will also get opened first half of this hospital. So the growth will come from there. At the same time, we are expanding our footprint in Tamil Nadu, which is Coimbatore. We are putting up some hospital which will get operationalized next 18 to 24 months time, and then the bigger one, which is the North India, which will come. But in the interim period, obviously we keep looking at opportunities where we can put up the hospital where the healthcare requirement is there. So as and when we identify, we'll keep on adding. So that will drive the growth in the interim period, where the biggest capex or the biggest capacity of 400 beds, which is coming in the Gurgaon. What we believe is that the Gurgaon is going to be the capital for the healthcare for the whole North India. It is an advantage north now because the government focus is also too much is on the North India, putting up the facility in terms of the infrastructures, road conditions, connectivity, etc. is very is much larger improving. The most of the capex or the infrastructures earlier was developed in the South India. Now the type of infrastructures, road, etc. is getting built up, and the connectivity across all the North Indian states is much larger. Say for example, Gurgaon to Jaipur or Lucknow or Kanpur, it is less than 5-6 hours, right? And in case of emergency, the people can drive down, reach out, or they can take the flight, medical ambulances, and then land out at Delhi. This is one part because we believe that whatever our peer group is also doing, they are putting up the large facilities in Gurgaon. We believe that the Gurgaon is going to be the hub, which was earlier the Delhi or other micro market locations. But I think Gurgaon will become a much larger hub, as has in South India. If you come, there are the 4 or 5 large cities like Chennai, Hyderabad, Bangalore, Vizag, and obviously Coimbatore in the Kerala, 2 cities which has developed as a healthcare hub. I think the Gurgaon is moving towards that. And in the next 5-6 years, we'll look at Gurgaon as a hub where the whole North India will flock for the healthcare. At the same time, in the pediatric space in the North India, there is nothing actually. So we believe we have a very high hope, and based on the discussion which we had and the internal assessment we have done, we have a high conviction of putting up that capex. And that capex, for that we have already procured the land, and few approvals have come, few approvals are expected, which we believe that it should be coming by February end, and the March we will do the groundbreaking. From there, it should take 2 years time to build that hospitals. We are putting up 2 hospitals. There one will be the larger multi-specialty, super specialty hospital of 300 plus beds. Another will be 100 plus beds.
Sure. And what about your ARPOB, sir? Because it's sharply higher than some of the other competitors. Is that number sustainable, 56,000 rupees odd? And what should one make of your return ratios? Would you continue to maintain a healthy return ratio, late teens kind of number? Is that the aspiration?
Yeah, so first is ARPOB. We believe that ARPOB we will be able to maintain and keep it growing inflation adjusted. Right now we have at around 55,000 rupees of the ARPOB. I think we will be definitely able to maintain that and keep it growing as a inflation adjusted. This is one. Second, as far as what was your second question on?
Your return ratios, sir. You're
Return
clocking
ratios.
very healthy ratios. Is that sustainable?
Yeah, we are very financially disciplined company. Any project which we take up, we ensure that the return ratios are at 20% of the northward in terms of ROC. So any project which doesn't yield the returns below 20% of the ROC, we generally don't take it up. And what also helps us is that we are out of our 19 hospital, only one hospital is our own. The rest is all on the leased model. So that also helps us to maintain a very healthy balance sheet and return ratios.
Very a quick last question, hopefully a 30-second answer. I wanted to understand your acquisition that you're looking to do in the Northeast as well as the Western markets. You did speak about it at the end of the quarter too, that you are still in very early phases. Anything that specifically we should look at in terms of both of these, because Western markets still very difficult to get into. What's your strategy for both these markets?
So for the Northeast, yeah, obviously, once we have seen the data, the healthcare is very, very much required on those areas. And as far as the acquisition is concerned, our strategy is very clear, is that we want to acquire the hospital who has followed the same principles and on the clinical side excellence which Rainbow has followed. Because in case of pediatrics or the mother care, what is very important is that you take care end to end, and the patient satisfaction should be up to mark. And on that space, very limited opportunities are available to acquire. But one or two opportunities which has come on our table is where the succession issues are there. They have built a good hospital, good system, processes, and the outcomes, clinical outcome is good. We are looking at that one. It is obviously is a little early to speak about whether that will get closed or not. But we are pursuing one or two opportunities,
Right.
and hopefully it get closed in 3 to 4 months' time.
Okay, great. Mr. Maheshwari, thank you so much for joining us today. It's been good chatting with you. It's been great breaking down Rainbow Medicare.
Thank you very much.
Right, with that, it's out of time on this edition of KYC. From Puneet, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.